Taxation of investments. It is nice to own stocks, bonds, and mutual funds and other investments. Nice, that is, until it's time to fill out your federal tax income return. At that point, you might be left scratching your head. Just how do you report your investments and how are they taxed? Is it ordinary income or capital gain? To determine how an investment vehicle is taxed in any given year, first ask yourself what went on with the investment that year. Did it generate interest income? If so, the income is probably considered ordinary. Did you sell the investment? If so, a capital gain or loss is probably involved. Certain investments can generate both ordinary income and capital gains income, but we won't get into that here. If you receive dividend income, it may be taxed either at ordinary income tax rates or the rates that apply to long-term capital gain income. Dividend paid to an individual shareholder from a domestic corporation or qualified foreign corporations are generally taxed at the same rates that apply to long-term capital gains. Long-term capital gains and qualified dividends are generally taxed at special capital gains tax rates of 0%, 15%, and 20% depending on your taxable income. Some types of capital gains may be taxed as high as 25% or at 28%. The actual process of calculating tax on long-term capital gains and qualified dividends is extremely complicated and depends on the amount of your net capital gain and qualifying dividend and your taxable income as well. But special rules and exclusions apply, and some dividends, such as those from money market mutual funds, continue to be treated as ordinary income. The distinction between ordinary income and capital gains income is important because different tax rates may apply and different reporting procedures may be involved. Here are some of the things you need to know. Categorizing your ordinary income. Investments often produce ordinary income. Examples of ordinary income include interest and rent. Many investments, including savings accounts, certificates of deposits, money market accounts, annuities, bonds, and some preferred stock, can generate ordinary income. Ordinary income is taxed at ordinary as opposed to capital gain tax rate. But not all ordinary income is taxable. And even if it is taxable, it may not be taxed immediately. If you receive ordinary income, the income can be categorized as taxable, tax-exempt, or tax-deferred. Let's talk about taxable income. This is income that is not tax-exempt or tax-deferred. If you receive ordinary taxable income from your investments, you'll report it on your federal income tax return. In some cases, you may have to detail your investments and income on Schedule B. Now we'll talk about tax-exempt income. This is income that is free from federal and or state income tax, depending on the type of investment vehicle and the state of issue. Municipal bonds and U.S. securities are a typical example of investments that can generate tax-exempt income. Now let's talk about tax-deferred income. This is income whose taxation is postponed until some point in the future. For example, with a 401k retirement plan, earnings are reinvested and taxed only when you take money out of the plan. The income earned on the 401k plan is tax-deferred. And by the way, a quick word about the ordinary losses. It is possible for an investment to generate ordinary loss rather than ordinary income. In general, ordinary loss reduces ordinary income. Now let's try to understand what bases mean. Let's move on to what happens when you sell an investment vehicle. Before getting into capital gains and losses, though, you need to understand an important term. It's called basis. Generally speaking, basis refers to the amount of your investment in an asset. To calculate the capital gain or loss when you sell or exchange an asset, you must know how to determine both your initial basis and adjusted basis on the asset. First, initial basis. Usually your initial basis equals your cost, which is what you paid for that asset. For example, if you purchase one share of a stock for $10,000, your initial basis on that stock is $10,000. However, your initial basis can differ from the cost if you did not purchase an asset but rather received it as a gift or inheritance or in a tax-free exchange. Next, adjusted basis. Your initial basis on the asset can increase or decrease over time in certain circumstances. For example, if you buy a house for $100,000, your initial basis in the house will be $100,000. If you later improve your home by installing a $5,000 deck, for example, your adjusted basis on the house may be $105,000. You should be aware of which items increase the basis of your asset and which items decrease the basis of your asset. Calculating your capital gain or loss. If you sell stocks, bonds, or other capital assets, you'll end up with a capital gain or loss. Special capital gains or tax rates may apply. These rates may be lower than ordinary income tax rates. Basically, capital gain or loss equals the amount that you realize on the sale of an asset. That is the amount of cash and or the value of any property you receive, less your adjusted basis in that asset. If you sell an asset for more than your adjusted basis in the asset, you'll have a capital gains. For example, assume you had an adjusted basis in a stock of 10,000. If you sell the stock for 15,000, your capital gain will be 5,000. If you sell the asset for less than your adjusted basis in the asset, you'll have a capital loss. For example, again, assume you had an adjusted basis in a stock of 10,000. If you sell the stock for 8,000, your capital loss will be naturally 2,000. Schedule D of your income tax return is where you'll calculate your short-term and long-term capital gains and losses and figure out the tax due, if any. You need to know not only your adjusted basis and the amount realized from each sale, but also your holding period, your taxable income, and the type of asset involved. For that, see IRS publication 544 for more details on that. Now let's talk about holding period. Generally, the holding period refers to how long you owned an asset. A capital gain is classified as a short term if the asset was held for a year or less, and long term if the asset was held for more than a year. The tax rates applied to long-term capital gain income are generally lower than those applied to short-term capital gain income. Short-term capital gain are taxed at the same rate as your ordinary income. Taxable income. Long-term capital gains and qualified dividends are generally taxed at special capital gains tax rates of 0%, 15%, and 20% depending on your taxable income. Some types of capital gains may be taxed as high as 25% or 28%. The actual process of calculating tax on long-term capital gains and qualified dividend is extremely complicated and depends on the amount of your net capital gain and qualified dividend and your taxable income. Type of asset. The type of asset that you sell will dictate the capital gain rate that applies and possibly the steps that you should take to calculate the capital gain or loss. For instance, the sale of an antique is taxed at the maximum tax rate of 28%, even if you held the antique for more than 12 months. Using capital losses to reduce your tax liability. You can use capital losses from one investment to reduce the capital gains from another. You can also use capital loss against up to $3,000 of ordinary income this year, or $1,500 for married person filing separately. Losses not used this year can offset future capital gains. Schedule D of your federal income tax return can lead you through this process. New Medicare contribution tax on unearned income may apply. So high-income individuals may be subject to 3.8% Medicare contribution tax on unearned income. This is the tax which first took effect in 2013. It is also imposed on estates and trusts, although slightly different rules apply. This tax is equal to 3.8% of the lesser of one of those two. Your net investment income, which is generally net income from interest, dividends, annuities, royalties, and rents, and capital gains, as well as income from a business that is considered a passive activity, or the amount of your modified adjusted gross income that exceeds $200,000, $250,000 if married filing a joint federal income tax return, and $125,000 if married filing a separate return. So effectively, you're subject to the additional 3.8% tax only if your adjusted gross income exceeds the dollar threshold we just listed above. It's worth noting, though, that interest on tax-exempt bonds is not considered net investment income for purposes, by the way, of additional tax. Qualified retirement plan and IRA distributions are also not considered to be investment income. Getting help when things get too complicated. The sale of some assets are more difficult to calculate and report than others. So you may need to consult an IRS publication or other tax references to calculate your capital gain or loss. If you would like more information about taxes in retirement, we have a 1-hour webinar about tax changes through the 4 stages of retirement. You see, many aspects of retirement will affect your tax bill in ways different than your working years. Our confusing tax system treats various income types differently and contains hidden taxes and penalties. The webinar link is in the description. It discusses the key tax issues you need to anticipate. See you there.